Recent note from Citi pointing to crypto weakness as a potential warning sign for equities, but saying liquidity could soon turn and revive risk assets into year-end. For more, Dirk Willer, head of macro strategy and asset allocation at Citi. Dirk, it is good to see you as always. Let's start with that recent note from you all, Dirk, where you were talking about Bitcoin's recent weakness as sort of this warning sign for stocks. Since you said, wrote that Bitcoin's even weaker, but start there, Dirk. What is this warning sign you're referring to?
Yeah, thanks for having me on. It's interesting actually that when the equity market was still doing really quite well, we noticed the divergence with Bitcoin, and it's actually somewhat rare. So Nasdaq and Bitcoin both trade with a positive correlation, and you had episodes in the past where Bitcoin diverged to the downside, and that was at times a negative harbinger. So we backtested that, and we found actually it's fairly reliable. So if Bitcoin trades below its 55-day moving average, the information ratio of the Nasdaq is just 0.5. If it's above, it's 1.5. And of course, both are positive numbers because we essentially were in a bull market for a long time. But there's meaningfully better performance for the Nasdaq when Bitcoin is essentially part of the bullish sentiment rather than when it's diverging.
So in your note, Dirk, correct me if I have this wrong, we're trying to find explanations for what's going on with Bitcoin. Were you pinning that on tightening liquidity?
That is one of the explanations. There are a couple of things going on in Bitcoin that are interesting. First, there was a flash crash in early October. And that, for Bitcoin itself, it was a 14% move down over 2 days. Maybe not that drastic, but some of the altcoins really got sold much harder. And after this flash crash, we saw that the flows into the Bitcoin ETFs and so forth really changed. So the flows really never recovered, and so retail was apparently somewhat shell-shocked by that day, and we saw outflows. The other thing that happened is that I think a lot of the institutional investors trade Bitcoin with a bit of a trend-following mindset, and so we broke some of the moving averages that they tend to look at, and that is also reducing the source of demand. But the third point is what you were mentioning, and that is that the liquidity, which we measure by bank reserves on the Fed balance sheet, dropped by a bit more than 500 billion. And that happened because the Treasury increased the Treasury general account at the Fed by selling a lot of T-bills. And there were two reasons for that. One is why this TGA account was so high. One is that that during the government shutdown, the Treasury didn't spend as much, so that account rose mechanically on the back of that. But secondly, they did sell more T-bills than is typical, and so we are thinking going forward, the liquidity squeeze, so that explanation for the Bitcoin weakness should actually get much better because we expect TGA to at the very least flatten out and probably decline, meaning bank reserves and liquidity should improve between now and the end, partly because of the reopening and partly because the Treasury sold so many T-bills already.
What I thought was interesting too, Dirk, is you were telling clients that stocks were holding up despite that tightening liquidity because of, you were saying, the AI story, the AI narrative. And I was wondering if you think that disconnect you're kind of pointing to there, is that sustainable into year end?
Yeah, I mean, we're obviously hoping that Bitcoin catches up with the equity market rather than the other way around. And, one reason for hope would be this improving liquidity environment. Having said that, there were, of course, two more structural negative stories for the equity market. One was that the December Fed cut was put in doubt. And, of course, a lot of the bullishness was based on the idea that the AI story is very strong, the equity market is very strong, and maybe in a bubble, and the Fed is cutting into that, and that is of course a very bullish development because usually the Fed is leaning against these type of U.S. equity market moves. Now, if the Fed would not cut, that removes part of the bullish story. I don't think that would be the end of the bull market, but it would certainly lead to a pullback, and we're seeing part of that. Now, Citi still expects a cut. Our economists still think December will be a cut, at least if we should get the employment data, because they expect weak employment data for October and November. If that comes out in time for the Fed meeting, we expect the Fed cut, that might be helpful. The other point you question is AI narrative. That has also weakened, admittedly, and there were many questions asked about, OpenAI in particular and so forth, and that has led to a pullback too. But we don't forget we get NVIDIA earnings this week, so that could reset the AI narrative.
Well, on the AI, what's interesting, Dirk, is you have these questions. I'm curious to get your take on it, on this sort of AI-driven debt financing, big tech issuing billions in bonds. I mean, do you look at that, Dirk, and say, okay, that's healthy, or no, that's bubble behavior?
I mean, it's a normal part of what happens. In 2000, you had a lot of debt issuance, of course, for the internet build-out, and that was not the sign that the bubble was over at the time. And of course, the hyperscalers in particular have very strong balance sheet, negative net debt, and could issue a lot. I think it's more the neo clouds and so forth where people get more concerned. We saw some of the CDS markets starting to move. For some of the sort of smaller companies outside of the hyperscalers, and that is never a great sign. But I would say just because the balance sheet is so solid of the hyperscalers, there is a fair amount of debt capacity left, and it's just a matter of which companies will have to finance it.
So bottom line, Dirk, listen, we're talking liquidity trends and AI debt, but bottom line, you're telling clients, they ask you where are the smart opportunities, Dirk, as we head into year end here and out to 2026. Where do you see them?
Yeah, we think it's too early to give up on equities, but we also advise hedges, because we do believe we are essentially in an AI bubble. At least in the macro strategy team here, we believe that. And I would say that is not necessarily a reason to sell, because often the last parts of these bubbles can be explosive. So we want to remain involved. But whenever you are in the bubble, you have to put more hedges on. I think that is quite clear. And we do think that credit is actually a better hedge for the equity market than is typically the case. Just part of the fact that we just mentioned, a lot of the build-out has to be financed on the debt side, and so credit should underperform equities, we think.
Dirk, always great to have you on the show. Thank you.
Thanks for having me.